Okay. 3, 2, 1. Is the picture coming up? There I am. All right. How you doing, friends? Ernie here, and this is the 0 Days to Expiration podcast. 0DTE, and it is Wednesday, December 22nd, just days before St. Nick will visit your home. Won't visit my home, but may visit your home. And today is a very interesting day. Today's podcast based on a tenet of everything that we talk about here at 0DTE, 0-DTE.com.
Returning visitor.
Everything that we talk about revolves around a minimalistic approach, a very Zen approach, a Buddhist approach, if you would. And that is that less is more. Where other 0DTE practices are trying to put on trade after trade, chasing after price, failing, hit, fail, hit, fail, hit. We don't do that. We take a very sure-footed approach. For 80% of our trades, we only put on a position once, and we might add to the position on rare occasion. Very occasionally, like today, we realize that after we've put the trade on, the market starts reversing for who knows why. Nobody knows. We decide to put on an opposing trade. If that works, great. If it reverses again and the other one works, great. But that's it. After that, the game is over. The most that we could possibly do is buy back the short strikes of the original trade if price keeps on going in our direction towards that second final trade. There are no adjustments, and the only reason we do that, the reason why we buy back those shorts of the original trade, is that once they become essentially worthless, the only value that original trade has in it is under the very unlikely case that the market decides to reverse again. Now, we've done that actually four different times, and 3 of those times they turned out to be huge winners. Pure luck. But it can happen. So we put on the first trade, didn't work. Put on the second trade, and now it's starting to go into our wheelhouse, so to speak. It started to move against us. Some people ask, well, what do we do now, Ernie? We do nothing. We took our shot at it, and that's it. Hang out, watch. Again, be unattached. That's the key. Be unattached to the trade itself. We get 3 opportunities every week, every Monday, Wednesday, and Friday, because options on the S&P expire every Monday, Wednesday, and Friday, unless there's a holiday on Monday or Friday, then it's Tuesday or Thursday, respectively. So we get 3 chances at this. Now, because we follow an asymmetric approach, everything about what we do involves asymmetry. Our risk to reward, asymmetrical. We won't even take a trade unless we have 1 part risk to 5 parts reward. That is orders of magnitude, or I should say, the exact opposite of what every other 0DTE practitioner does. So we take a 1 to 5, sometimes a 1 to 10, whatever works in our current situation. So that means that if we lose practically nothing. It cannot hurt us on a loss. We cannot be hurt if we take that minimalistic approach and you don't pile on. Now, I know that there are a lot of new traders that are in the service that like to, once they put that first trade on, they want to know, well, when can I add another one, Ernie? What's your strategy for adding another one? And really, my answer is, I don't have a strategy, really. Unless I feel like that's our only opportunity, then I might add one once we get a price that's 25 or 50% better than the price that I originally went into. But even then, I'm kind of like, well, do I really want to do that? Be completely unattached to the trade? If it wins, that'd be great. If it loses, no big deal because the loss is so tiny. If it wins, not only can it make our day, but it could potentially make our month because the wins can be that big. So everything for us is on the upside. We have no business trying to manage the downside. Managing the downside is a losing strategy. Managing risk is, in fact, the practice of figuring out just how much you're going to lose. It is the practice of losing, managing your risk. Managing your profits is the practice of winning. But in order to do that, you must take this minimalistic approach. Take on the maxim of less is more. The less we trade, the more we make. That is an absolute truth in what we do. That is, if you follow the asymmetry, if you take advantage of the edges that we employ from the overstatement of premium, from the analysis that we provide in volume profile, understanding the market structure, understanding the potential behavior of the market as it traverses across that profile, taking advantage of things when there is a catalyst in the market and there's some momentum and we can develop a bias. And with all of these things, we don't have to trade often. We make our determination early on. We place the trade. About 80% of the time it comes through. Once in a great while, like today. See, what happened today was there was what we call a catalyst in the market. The GDP numbers came out this morning. And for all intents and purposes, from an economic point of view, they were positive GDP numbers, which in the parlance of the times, the vernacular of the times, anything good for the market or anything good for the economy is actually bad for the market because we're living in opposite world. You've probably heard me talk about that before. But what that really means is that opposite world is that world where if you have a heated economy, the Fed is going to want to do the exact opposite. They're going to want to stem or pare back or temper that heated economy. They don't want inflation to get out of control, which it already is. So the idea from an investor or a trader's point of view is that when they see good economic reports, that usually means that the Fed, or they anticipate that the Fed is going to do something to try to temper and subdue the pending inflation that might happen from that event, or not from that event, but from that eventuality, that situation, that regime that we're in. If the report is unusually bad, that usually results in the Fed being very accommodative, being dovish, keeping rates low, injecting more quantitative easing, or quantitative easing is injecting cash into the economy. And that would be good for the market, and so they want to push the market up. Now, today, the report was good, and then the market started to come down summarily because of opposite world. And then for whatever reason, it went exactly the opposite way. And not just a little bit, with a vengeance! Which we thought was quite unusual, so we went with it. Our first trade was a bearish trade, and it started to work out. Market decided to turn right around, and so we said, okay, Mr. Market, we're not going to fight you. We're going to do exactly what you want. And so we put a bullish trade on, and now that's working out. Once the trade got far enough away from our bearish trade, we bought back our short strikes because they have really had petered out. They completely decayed. All of their value was gone. Might as well buy them back. Just in case the market decides to turn around again, then we have naked long puts. And they would be supercharged. So then if the market comes down, then we can profit from that. That's a minimal thing that we can do, and it's really kind of a maintenance thing, not even a risk adjustment. It would have been less risky not to take the short strikes off at all, let them expire, because then they would expire fully. But we're willing to take on an extra 5 or 10 cents worth of risk in the off chance that the market reverses again and gives us what we want. Very simple, very unattached, no judgment, nothing like that. Here we are. we got this nice little pop in the market. We went bullish today, and that trade was working out, and then it started to pull back. So now people are asking, oh, Ernie, we made that second trade. Now I don't feel so sure about it. Are we going to do something? And I said, no. We're minimalists. We took 2 shots. That's 1 shot too many in my book. So we do nothing. Besides, in these particular types of cases, a lot of times you get that pop up, then grind right into the close. Once in a while, it will pull back again and then pop right back up again, which is exactly what's happening today. So if everything goes as planned, this should be another big win for 0-DTE. Thank you very much for informing me of that black screen. Really appreciate it. And again, taking that minimalistic approach. Unattached, because why are we unattached? Well, first of all, like I said, we are skewed towards winning. We manage our profits, not our losses, because our losses are so small. Our losses cannot hurt us. However, our wins can make our day, our week, our month. That's how skewed we are. You would think, though, under those types of conditions, you must be very low on the probability of winning or win rate. And that's not true at all either. Because of the strategies that we use, the methods that we employ, our win rate is, most of the time, when volatility is up there, 75 to 95%. I'm going like on a weekly basis or a monthly basis. Occasionally, when we have super low volatility, our win rate goes down. But our return, our average return, does not really suffer that much. And we still have that same kind of skew in terms of risk to reward. So we're always playing this game. We always have a high win rate and a high return on capital. That's what it is like trading the 0-DTE way. So if you'd like to give it a try, we have a 4-week trial. And I'll have a special deal, I think, for people who try out the service right up until the end of the year. We had a slight little Christmas deal that we did for a little bit, and that was extremely successful. Got all kinds of new people in. They're all very happy. We're all a big happy family here. But I think I will do something special for the last few days of the year when we go into that right after Christmas time into the new year. So if you'd like to try it out now, now's the time to get in. Go to 0-DTE.com/try. That's TRY. 0-DTE.com/try. And you too can learn how to practice minimalism. And a lot of people don't know this, but believe it or not, I am a practicing Zen Buddhist. I am also, in a lot of ways, a Taoist. And in fact, here's something that's really a little bit askew. I am a Buddhist priest, which is kind of like a sect of Taoism. If you ever watched The Big Lebowski, The Big Lebowski is a cultish movie that is loosely based on a character who takes on this Taoist type philosophy. Live and let live. Everything is a minimalistic approach. Just hang in there, dude. Abide. But that is the same kind of philosophy that is actually engendered here in this strategy as well. Unattached. Just let it happen. Take asymmetric opportunities. Let the market come to us. We do not chase the market. And it is a phenomenally successful strategy. Let's see, where are we now? Well, we're still up there. We've got half an hour left in the market. Let's see if we get that next little push. If we break the high of the day today, we will be phenomenally profitable. If we don't, then we don't. That's the way it goes. All right. I want to thank everybody for joining me here. Let's see. Do we have any questions? No questions. Unbelievable. Nobody in the peanut gallery. All right. Thank you, folks. We'll be back here Thursday for the last trade before Christmas. All I can say is, hey, dude, abide. See you next time. Peace. Okay. Where is that off button? It's way up there. There we go.